Ladies and gentlemen, welcome back. This is week 13 on my journey to 100K. This is your host with the most, the Diamond Hands Prodigy, otherwise known as the one and only. How you guys doing? All right, so there's been a lot of stuff going on in the market. It's been very turbulent, and we thought we were gonna see all-time highs, or at least that's what the bulls thought, but the bear says psych. And on top of that, historically today, the day before Good Friday, it's supposed to be a pretty bullish day. I want to say the past 25 out of 26 days before Good Friday have been green days. So today we defied those statistics, and it looks like we're about to close bearish on the session for the week as well. Don't forget, guys, tomorrow is Good Friday. For those who celebrate it, I hope you enjoy your time with your family and do realize that the markets are closed tomorrow. This video is being filmed on Thursday, March 14th, again, meaning that March 15th, tomorrow, the stock market will be closed. And in other news, inflation came in extremely hot yet again. There's that pesky inflation. It seems like we're never gonna get rid of this problem. Prices just keep going up and up, and now I'm starting to even wonder if it's even worthwhile to go get groceries. Like, honestly, it's about the same price as just ordering DoorDash at this point. These prices are getting pretty ridiculous. Something needs to be done, but the feds are just taking their sweet time, and whenever they do decide to turn hawkish, then it's gonna spell doom for the stock market, since the feds will no longer be supporting the stock market. They are also reducing the balance sheet, which isn't really helping the stock market either. See, the thing that you guys have to understand is that when the feds reduce the balance sheet, that essentially means that they're gonna cease their bond buying, which means less money out in circulation, and actually they're bringing it right back in, removing it from circulation, thus increasing the power of the dollar. But at the same time, the stock market is not being supported anymore, and this is why we're seeing a ton of bear action. This is not the same bullish stock market some of you guys have been accustomed to. For those that started investing in 2020 up until the beginning of this year, all you knew was bull. All you knew was green candles and buy the dip. But be very careful, because this is a very different stock market. All right, and I wanted to make this one very short and sweet. So with those two pieces of information and news out of the way, let's go ahead and hop into the portfolio. The portfolio has been doing pretty well. Right now it's sitting at about $6,060. Now it would have been better, but something happened today that's both good and bad. And that's that Snowflake tanked dramatically. So just today, Snowflake is down a whopping almost 7%. It's sub $200 now. So what does this mean? This means that our leaps right now is temporarily getting obliterated. If you guys remember from week 10, we were up a substantial amount. Actually, let's go look. So I want to say that video was released around March 26th. So March 26th, that leaps was worth about $5,000. Now it's right back down to about $3,400. That's kind of how it's like with these volatile stocks like Snowflake. But what's really cool is that our Snow short call is now set to expire worthless now. Check this out, guys. I'm gonna love scrolling down to this. Boom! So we see a 99.96% gain for $2,295. This is because today is expiration date for this short call. So unfortunately, whatever bull bought this call from me is probably crying because they lost out on their entire premium. That $2,295 will remain in my portfolio, in my pocket, and after market hours, my portfolio value should be adjusted, because that's the nature of selling covered calls. Whenever you sell someone a short call, you are on the hook. So your portfolio can't really give you a positive or negative value until you buy to close it, or until it expires worthless. And that's really important. So in our case here with Snowflake, once the market does finally close, that $2,295, boom, will be added to our portfolio value. So in reality, we're at about $8,300. So it's really not looking all that bad. We're slowly climbing back up. And best of all, what we're gonna do today is we're gonna delta hedge a little bit, which don't worry, I'm gonna get very much in detail later on, and it is an advanced concept. So some of you beginners may be lost. You guys might get lost in some of these terms, and that's okay. DM me, or if you have any questions, just drop them down in the comment section below. All right, so this is what we're gonna do. Today, we're discussing the Greek delta. So some of you guys who buy calls or puts know the Greeks very well, or at least you should. That is delta, gamma, theta, vega, and rho. Arguably, all of them are extremely important, but delta arguably is one of the big dogs. It is a first derivative of the Black-Scholes model. Now, hold on. We're not gonna get into that fancy mathematics stuff in this video. All you have to know is that in essence, delta measures how much your stock call option or put option will increase or decrease depending on a $1 increase or decrease yet again of the underlying stock price. Let me repeat that again. The Greek delta affects your contract in the following way. If Snowflake were to go up $1, and let's hypothetically say that our deltas was 0.540, that means that for every dollar increase, we can expect our call option to increase about $54 should all the other Greeks stay frozen in time and remain constant, okay? So there's a lot of variables, but in essence, that's what it means. Now on the downside though, if it decreases by $1, that also means that the call option will be reduced by $54, okay? So I'm hoping that's making sense. And by the way, sometimes when people read delta, some people will say 0.54 deltas. I like to say it as 54 deltas. They're synonymous, but at least in my brain, when I say 54 deltas, it's a little easier to convert. You know, it's already converted in your head. You can kind of think about it as dollars, deltas, dollars, right? So if we look at our snow position right here, we have a delta actually coincidentally of 0.5452, or as I would say it, is 54.5 deltas. Again, that means that if Snowflake were to rise by $1, we can expect our call option to increase by roughly about $54.5 should everything else remain constant. Now, because our short call is gonna expire worthless, this is really good for our naked leaps. What we want to do here, at least the goal, is we're gonna leave it alone for now. We're not gonna roll this position. We're not gonna roll another short call option because right now snow is in the gutters. What's most likely gonna happen is that Snowflake will inevitably shoot right back up eventually, or at least that's the theory. Right now it's getting beaten down extremely, and the technical analysis says that this will most likely recover. So what we're gonna do in this case is we're gonna buy the dip, but not in the traditional sense. This is what you guys should start doing every time there's a big dip in your favorite stock. So check this out. Once again, our short call will expire worthless. We don't even have to worry about that. Those $2,295, cha-ching baby, that's in our pockets. So we won't have to worry about another short position counteracting our long position. Therefore, what we're gonna do is we're gonna roll this one down in strike, therefore increasing our deltas. And by the way, when you see 54 deltas, in essence, that's like you're controlling 54 shares of Snowflake or whatever underlying stock you have. Now, I know that that may sound very confusing, but let me give you an analogy. If you were to own 54 shares of Snowflake, that's a ton of money. Let's do some quick math. That's $200, which is the share price of Snowflake right now, times $54. You would need to spend an aggregated amount of $10,800 in order to have the privilege of controlling 54 shares of Snowflake. Now, let me ask you something. If you do in fact own those 54 shares of Snowflake, and if Snowflake were to rise by $1, how much did your 54 shares appreciate by? $54, right? Because if Snowflake rises by $1 and you have 54 shares of them, then you've netted a $54 profit. Well, that's the same thing you're doing with calls, only it's costing you a ton less capital, and that's the power of call options and put options. So again, when you look at your deltas and when you see 0.54, you can, in essence, in your mind, kind of think, oh, that's like controlling 54 shares of Snowflake. The higher the deltas, the better. But obviously that call option is going to cost more the more deltas it has. So imagine if we only had a delta of 0.08 or only 8 deltas. In a roundabout way, we can say that we're controlling around 8 shares of whatever stock that is. And if it were to rise or go down by $1, then you can see how that works. So I hope that made sense. If that wasn't clear to you guys, definitely rewind. It'll start to make sense, I promise you. Once you get this nerdy stock option stuff down, it's like in your head, it'll just make sense. It'll just click and you'll know exactly what's going on when you sell a put, when you buy a put, when you sell a covered call, diagonal spreads, all of that will start to make sense. I promise all you have to do is put some time and effort into learning some of this stuff because it is like a foreign language and nobody will be able to understand this in just one day. It took me months, maybe even years to understand it. So now finally onto the play. What I did want to show you guys is, again, we're going to delta hedge. we're gonna increase our deltas and we're gonna pay a debit to make our Snowflake leaps a lot stronger. Therefore, whenever Snowflake does decide to rise again, we're gonna have more deltas to back it up, which means we're gonna make more profit in the long run. And once it rises in value, we're gonna figure out using technical analysis what precise moment we should sell a call against. That way we collect a fatty premium. You'll see what I mean. And whenever I do sell that call against Snowflake, I do want to get it on camera. So rest assured, I want you guys to learn with me. So I did buy 2 puts for Snowflake at the $170 strike. And honestly, we've got a quick double up right here. So as you can see, we're up 105% on this position. I saw the TA on Snowflake and it might have a little more room to the downside. So we're only gonna get rid of 1. It's really important for you to hedge your portfolio and collect your profits while you can. It would be a mistake to just let this ride, and let's say Snowflake does explode to the upside, then our puts are gonna be worthless. So might as well collect at least 1 of those contracts with a 100% gain. So we're gonna sell 1 of those contracts and we're gonna go right at the, well, this isn't the mid price, but it's $310. Let's hope it gets filled. It got filled. So we received $310 for that, and we're gonna use those $310 now to reduce the strike on our Snowflake position. So because we own 1 leap, so you can see right there, it's +1, we need to get rid of it, right? So we're gonna sell it, and then we're gonna simultaneously buy a call, maybe $10 strikes below it. So we're gonna go to this one right here. So we're doing this all in one transaction. We're gonna look at our summary, and it's gonna cost us about $415 to do so. But what's really important is, once again, we're gonna delta hedge. Our the current Snowflake position that we have right now has about 54 deltas. Our new call that we're interested in now rises to 58 deltas. That's $4 more for every dollar increase in Snowflake. But not only that, we're gonna cover other Greeks later on in other videos, but gamma is a second derivative because gamma is dependent on delta. So gamma cannot move unless delta moves, right? So now I'm getting to that really nitty gritty nerdy stuff that I learned in my options class. But don't worry, all of this will start making sense. For now, let's just focus on delta. Let's go ahead and run this play though. We're gonna review. Yeah, it's gonna cost us $405. Hopefully we get a fill, and let's see what happens. We did not get a fill, so let's go ahead and replace it. And remember guys, in order to get filled, because we didn't get filled, that means that there were no sellers willing to meet us. So now we have to keep going up in price. Let's try $415 and let's see if that's a little more effective. We're waiting, still nothing. So gotta try now. Let's try $430. Might as well. I don't want to keep trying over and over and over. $430 should do it. There it is. So now we rolled our position to a more advantageous strike, and this will benefit us in the long run. Once again, this is very equivalent to buying the dip, but instead of spending $800 to control 4 more shares, instead we only spent about half of that. We got 4 more deltas added to our position, and now whenever Snowflake does decide to rise, it's gonna rise with much greater force, and our profit will be much higher. All right, guys, aside from that, our XOM, our ExxonMobil positions just have not moved. ExxonMobil has still stayed above $80 and it continues to be on the rise. Who knows when this is gonna drop? That's okay, we can't win them all. But the good thing is I did buy some insurance. As you can see here, since I owned 15 of those puts, I sold 10 puts to someone else as a form of insurance. It wasn't much, but when I originally sold them, I collected about $40 worth of premium, which wasn't bad. It offsets what I spent on these puts right here. So overall, yes, it's still a negative position, but keep in mind, Snowflake right now is our biggest gainer with that short call. So they kind of washed themselves out and we're still profiting thanks to this short call. What else? So we did buy more Coca-Cola shares throughout the week. Now we're up to 8 shares, and Coca-Cola has been on a tear lately. Look at that. I mean, it is extremely overextended, I'm not gonna lie, but we can manage. We're up about 6% on that. DraftKings has been down. Lately, yet again, we're down 12% on that. IWM, we're down only 3% of that. And we have IJR, and we're only down about 1%. Bitcoin lately has been slumping. It's now under 40,000. And so we're going to go ahead and re-up a little bit on a little bit of Bitcoin. Let's go ahead and buy $40. And now I want to buy a share of a stock that practically owns everything around us. Not really, but kind of. And that's BlackRock. So BlackRock is an amazing dividend paying stock that has also historically performed extremely well. Over the past 5 years, it's up 78%. And at its peak, BlackRock was about almost $1,000 per share. So as you can see right now, it's down to 690. We have to take advantage of this bear swing because eventually we're gonna hop right back onto that bull. Who knows if a recession is coming, but inevitably we're in this for the long run. I'm talking 3, 4, 5, 6+ years later. So let's go ahead and buy one share. We should have enough. There it is. And there's our share of BlackRock. So for now, once again, we're gonna be very, very patient, and we always have conviction in our plays. While we're down right now, we're not going to be like this forever. We have been stuck within a range for quite a while. As you can see, for a whole month now, we've been between the $7,000 and $6,000 range. But no worries. After Good Friday, after this holiday weekend, if we have a bear swing or a bull swing, it won't matter because we've positioned and hedged our portfolio so that no matter what direction the stock market goes in, we're making money. We still have some puts. Our ExxonMobil puts still have a week. They still have some time to potentially make something happen and recoup some of our losses. And then we have all of our shares of stock that we have here that we're going to own for 10+ years. So ladies and gents, we are still on this road together. It is taking a while, but that's how you have to do it in the stock market. You have to be patient, and you can't expect to become a millionaire from one day to the next. Some people get lucky, but that's just the nature of the stock market. It's like for those people that do win the lottery in the stock market, great for them. But a tried and tested true strategy is just to hold on to your guns so long as you're buying good, sound companies with solid fundamentals like we're doing, and all we have to do is wait and reap the benefits later on. All right, guys, this has been your quick update on week number 13. I do expect to see you guys next week as I'm done with most of my tech reviews, which means that now I can focus on this channel a little more. I am going to start offering some podcasts on this channel with special guests from my friends and fellow investors around me. So if you're interested in that, definitely stay tuned. And before you guys head out, go ahead and drop a like on this video and consider subscribing for more investing content just like this. Next week, I'm gonna make a video on credit scores and how you can improve yours. So stay tuned.